Welcome to the Private Equity Exchange, the only summit bridging the gaps between limited partners, private equity funds, corporate executives, and entrepreneurs. With over 1,000 delegates, the Private Equity Exchange is the only venue where LPs, private equity firms, corporate executives, and entrepreneurs meet. Before the events, using our internet platform, schedule one-on-one meetings with delegates that matter most to you, and exchange far more than business cards at your deal meetings at the Private Equity Exchange. Gather great market insight with over 120 speakers and 6 tracks to choose from. The Private Equity Exchange, the largest private equity event in Europe for CEOs, funds, and LPs. You are looking at LBO for professionals. Great insights from private equity leaders, lasting trends in the next decade. Introducing
Good morning and welcome to today's first session of talks in track 1, Great Insights from Private Equity Leaders, Lasting Trends and the Next Decade. My name is Faye Sanders and I'm Deputy Editor of Private Equity Europe, which is a monthly private equity journal focusing on fundraising, buyouts and exits across the European market. In this discussion panel, we'll be looking at private equity's market evolution over the next 10 years, focusing on some key topics which will be introduced by our distinguished panel of speakers. So I'm joined here today by Philippe Costeletos, who's the partner and co-head of Texas Pacific Group in Europe. Philippe has led a number of large-scale buyouts, such as TDF in France, Tim Hellas and Q Telecom, which was Greece's largest and first large-cap buyout, and also the 3 billion take private of Debenhams in the UK. I'm also joined by Simon Patterson, who is principal at Silver Lake Partners. He joined 2 years ago, moving over to their London office, which opened last year. And he's notably worked on Europe's largest ever technology buyout, which was when the firm acquired Philippe Semiconductor for some 8 billion earlier this year. I'm also joined by Pascal Meysson, who is Executive Director at Alcentra, Europe's largest institutional investor in loans, in leverage loans. He is in charge of Alcentra's investments in France and Southern Europe across all funds and deals with Alcentra's mezzanine fund. Kanako Sekine is Director of the European Bank for Reconstruction and Development. She's responsible for the group's investment program in private equity funds and in co-investments. And finally, I'm joined by Sabine Schaffer, who is the Vice President of Evolvence Capital. She's currently focusing on establishing alternative fund opportunities in the Gulf region as well as in India. Okay, we're going to kick off what promises to be a very lively and informative debate with 5 brief presentations. I'd like to keep the session as interactive as possible, so there'll be plenty of time for questions in the second half. So, first of all, Philippe has prepared some slides on mega funds and the globalization of the buyout industry.
Good morning. Well, one of the questions has been what have been the drivers of the buyout industry the last 5–10 years. I think our thesis would be that it's been the large buyouts and the average size of transaction that's driven the growth, not the percentage growth, but the actual growth in terms of dollars over the last decade in Europe. If we look at the funds raised and distributions to LPs, it's been a last 5 years, everything's going up and to the right, and maybe we can talk a little bit about why that is happening. So in terms of large transactions, if we look at the last 3 years, 93% of the growth has come from buyouts that are greater than $1 billion. Now, 60% is over $5 billion. My view is that that will continue. We will continue seeing larger investments, larger buyouts. The capital markets are allowing firms such as ourselves and others to access large opportunities. The size of funds, as Luis mentioned earlier, few years ago, 3 years ago, a mega fund was a $5 billion fund. Today it's 15. Soon it'll be 30, and going up from that. We can talk a little bit about the evolution of those firms and what's driving that. A lot of people talk about there's excess capital in the system and too many funds being raised. When you look at the data, the amount of investment has increased, has surpassed the rate of increase of funds being raised, so that the overhang is actually low. To echo what the keynote speaker said, the percentage that private equity represents in terms of funds invested globally versus the total investable capital is a fraction. If you were to round up all the large private equity, the amount of capital under management, I think the number will be off by a few billion, but just orders of magnitude about $385 billion, which is something like 1.5 times Microsoft's market cap. So people talk about the sector having too much capital and too much chasing too few opportunities. The issue is that a lot of firms chase the same investments, and the obvious targets in a business undergoing auctions, everyone goes after the same opportunities. As an investor, you have to look for value where others don't, whether it's by sector or by geography. So if we look at our investments over the last sort of decade, we've tried to focus on sectors that have been out of favor, whether it's airlines, technology, and retail. Try to invest at a time where people have pretty dim view of the sector and its opportunities, and also to go to geographies where other people perceive it to be too much risk. So I think as an investor, you have to challenge yourself all the time to look for value, to look at differential value and take a different point of view rather than effectively chase the same opportunities. What you're seeing is the share of private equity as a percentage of M&A transaction has gone up, and I think if you look at the U.S., the percentage of public to privates by private equity firms that are going unchallenged by strategics has been phenomenal. That's will change. I mean, you'll see more strategic firms and more corporates competing for the same assets, but the last 5 years have been very benign for the industry. Management. I think if one thing which is a tremendous competitive advantage has been our ability to attract the best management. The opportunity for management or a CEO to run a business away from public scrutiny, and that doesn't mean that they're not accountable. On the contrary, they're very accountable, but they don't have to spend half their time re-explaining their business plan or strategy every 6 months. In a public company, they find themselves with a few hundred shareholders who churn their stock every 6 to 9 months. As an industry, we spend months diligencing the business, developing a business plan with management, and it's that contract ultimately which provides better governance. I think that the term governance arbitrage is one will be used frequently going forward. And there's no doubt that we have the ability to attract the right CEOs for our businesses. There are some CEOs that prefer to run large public businesses, in which case they can continue doing that. But for CEOs who want to be very focused, have a business plan, 5-year business plan, sit down with their shareholders once a month and have a very detailed, focused discussion, and have the opportunity to create wealth if they create value without being criticized every 6 months for their options package and how much they're being paid. Private equity offers that, and I think that will be a sustainable competitive advantage relative to the public markets, and why you're seeing a number of high-quality CEOs joining private equity portfolio companies. Financing. A lot has been said about the financing markets, and they have been very benign, and I think people are talking about a credit bubble, and there is a lot of the leverage multiples are an all-time high. And sometimes you confuse some of the structures with my children's alphabet soup. But I mean, the number of layers that you're seeing in structures is getting excessive, I would say. Having said that, the better structures today are allowing owners to structure, to put together capital structures that will provide the businesses more flexibility, more time when things go sideways. So this year, default rates in Europe are about 0.5%. Some may argue that some of the credit is being mispriced because people are not forecasting enough of an increase in default rates. That may be true. On the other hand, some of the better businesses that are properly structured, you find a lot of the amortizations are back-ended, a lot of the covenants, if there are any. Here's an example of a business we bought in 2000, we bought again in 2006, just comparing the capital structure of those two financings for the same business 6 years later. And what this allows us to do is, effectively, if there's a down cycle in the US, we can work through it. Now, that's the good news. It'll allow shareholders and owners to manage businesses, to cure or invest or change management if businesses don't perform. But it also means that problems may take longer to surface. And so what will happen is when people talk about a cyclical downturn, it's likely to take longer than it did in the last cycle. We talked about growth, and we are in Europe, but I think the most exciting growth area is in Asia right now. We're seeing a surge in private equity opportunities, both large buyouts and minority investments across Asia. And if you look at the percentage of private equity dollars invested as a percentage of GDP, and you think about the GDP growth in Asia versus either the US or Western Europe, you'll see why the number of entrants in the Asian market is growing. We've been in Asia for the last 12 years. We have 35 people across 6 countries and 6 offices. But often it's a different type of investment. There are a number of large-scale buyouts being done this year. We bought Myers Department Stores in Australia, which is Australia's largest department store. But we also have minority stakes in a number of public companies. So whether it's Parkway, which is South Asia's largest hospital chain, or Lenovo in China, the laptop manufacturer, or Shenzhen Development Bank, these are all structured minority investment in public companies. A number of Asian families don't want to sell control. So the form of investing in Asia will often be to buy minority stakes in either public or private companies, which is something that some private equity firms need to learn how to manage. Obviously, the issue of governance being the most critical. But the growth is there, and it will continue. And I wouldn't be surprised if 5 or 10 years from now, Asia represents a significant share of private equity dollars being invested in that region. Well, what does this all mean for the industry? It's an industry that's grown very fast. As we talked about previously, 5 years ago, or 3 years ago, mega funds were $5 billion, now they're 15 to 20. We are seeing and will continue to see the same bifurcation in the private equity sector as we've seen in the banking sector, which is that you'll have a handful of large global investment firms managing increasing larger amounts of capital on the one hand, and a number of focused niche investment firms, either focused by sector or by region, by country at times, on the other. And I think everything else over time will find it difficult to attract capital. And I think you've seen the same bifurcation in the banking sector. I think most financial services sectors have seen that, and I think private equity just takes longer, but I think we'll continue to see that. So today, if you look at the larger private equity firms and the concentration of capital and fees being paid to the investment banking community, it is being increasingly concentrated amongst the larger firms. And that's creating, obviously, a spiraling effect in terms of the opportunities that are shown and creating a close relationship. Now, how the industry has evolved, I think when we look at a lot of these firms are started by bankers or investors and went out and did deals on the back of the relationships. Over time, we've seen in the bull market of the 80s, structuring deals was what people are doing to create value. Increasingly, people have operating teams and people with operating experience in their team to help in due diligence and in portfolio companies. But what's effectively happening is that the issue of firm building has become and is becoming the most important part of the development of the industry, which is how these firms are evolving from funds to firms addressing issues of succession, globalization, growth. Today we have 110 professionals globally. We've increased our headcount by 40% in the last 3 years. So there is a leadership and management issue which a lot of these firms are addressing. And I think you're going to see an institutionalization of some of these firms on a larger scale happening. And I think the success of the growth of some of these firms will be dependent on how well they're managed on a global basis. And that's a different focus for people who basically came into the business to do deals and invest. So I think a lot of differentiation will come from leadership and management skills. But just to close, I would say that the industry will continue growing. The large scale, large end of the market will continue driving a lot of the growth. We'll see a lot of growth in Asia. There will be an increase in default rates. It won't be as quick as people expect. But given the people are scared about the size of the sector relative to where it's been, but it's early days, and the sector will continue growing, and it's a question of performance at the end of the day, and why our LPs continue investing is that we produce alpha returns. Thank you, Faye.
Silver Lake as a firm is focused exclusively on investing in technology, and so today I'm going to talk a little bit about some trends within the technology sector that make it of particular interest to private equity investors. First of all, you wouldn't describe technology as a niche sector. The technology sector, drawn narrowly, if you look at just software, services and hardware, is worth $2 trillion in revenue worldwide, 7% of total GDP, 11% of market capitalization. If you take technology and define it more broadly to include businesses where technology is a part of their business model, the number is very much larger than that. Technology is obviously a high growth sector. Over a long period of time, the sector has outpaced GDP growth. There was a period of time, obviously, in early 2000s when that was not the case, but if you look over a 40-year period, technology has been growing sort of 2 times GDP growth. The reason for that is on the right-hand side, you can see that increasingly technology is a much more important aspect of capital spend as companies across the whole of across the whole of industries are trying to differentiate themselves by using technology in their business model. Put both of these things together, we've seen a dramatic increase in the value and volume of buyouts within the technology sector. When Silver Lake was started about 7 years ago, really the concept of a technology buyout was completely alien to the private equity sector. You can see now in 2006, we estimate there will be of the order of $50 billion worth of technology buyouts carried out. So what are some of the trends that are of interest to the private equity investor? Well, first of all, obviously the growth is an important feature. Secondly, we're seeing a new generation of computing that's taking place. Over a period of time, the center of gravity within technology has shifted from the mainframe to the workstation to the PC to the internet, and really now the center of gravity is shifting towards mobile and handsets. Next year we'll cross the 3 billion mobile user threshold, and that compares to 800 million PC users. So there's a very big difference between the usage of the handset worldwide. In addition to that, video is becoming, there's an example of a handset over there, video is becoming particularly important the technology supply chain is crafting itself around the delivery of moving picture content. You're seeing, for example, within semiconductors being crafted for high-definition TV. You have Blu-ray, you have TV on mobile, you have IPTV. It's driving a lot of change throughout the entire value chain. Consolidation will continue to be an important trend, and private equity can be an active participant in that respect. And of course, globalization will also continue to be an important trend, both in terms of, on the supply side, companies shifting effort to low-cost geographies, and on the demand side, as India and China become very important participants within the global economy. Another interesting thing that's going on is that the focus is shifting away a little bit from the US, both in terms of demand and supply. Right now, the US actually accounts for less than a third of technology procurement worldwide. Over on the right-hand side here, you can see, if you look across a number of different technology markets, the US's share of those markets is diminishing. For example, in handsets, the one I was talking about before, the US accounts for only 17% of the handset market. That's down from 26% over the last 10 years. The same thing is happening in terms of internet usage, semi, and also PCs. Down on the left-hand side there, you can see that the US share of technology-related financings in the equity markets and the debt markets has come down from 60% in 1998 to 40% currently. So Asia and Europe as well, in particular, are becoming much more important aspects of the overall technology landscape. Another interesting feature of technology from an investor point of view is the distribution of valuations. A lot of people, when they think of technology, they think of growth investing and high valuations, high valuation multiples. Well, that's not actually the case if you look at the data. Here on the y-axis, you can see we've laid out the valuation metrics here, price to sales, and then the cumulative percentage of companies across the x-axis. You can see there's a small number of companies with very high valuations that create the impression that everybody has about the technology sector. But there's also a long tail of companies that are more reasonably valued and trading at the kind of values as a private equity investor you would be potentially interested in. And so the key question I'm sure you're all thinking is, are there any companies within that tail that would be interesting to own as a private equity investor? Well, it turns out the answer is yes, there are. Another way of looking at the same data here, we have on the y-axis valuation multiple in terms of forward PE. On the x-axis, the consensus growth rates of those companies. Turns out within technology, and this is really something that's kind of unique to technology, a feature of the sector, is that there's actually very little correlation between value as perceived by the public markets and growth as perceived by analysts. And the reason for that is that these are very difficult companies to value. When we do our diligence, typically looking at technology companies, there are very complex dynamics within the market, there are very complex dynamics of the company. You have situations where you may have volumes growing at 25 to 30%, while at the same time prices are declining at 25 to 30%. You have complex dynamics around manufacturing, cost of goods sold, and operating expenses. It's tough. You have to make assumptions along a wide range of dimensions. It's easy to get one of those things wrong and come up with a completely different conclusion to another person looking at the same business. And that's why you see this sort of differentiation here across values relative to the same perspective on growth. So the really key thing about investing in this sector is specialization. You need to have the long experience of investing within technology to be able to differentiate between the dots on this page. Just to conclude, there are 4 trends that I would like to draw your attention to that really make this an interesting sector for private equity investing. First of all, technology now is a maturing industry. As the industry matures, the large technology conglomerates are starting to restructure, starting to focus on their core assets. And so that means that businesses come up for sale. There are a larger proportion of actionable opportunities now within the technology sector. A good example of that is Philippe's semiconductor division, the buyout which we co-led over the summer this year. The company is now called NXP. The second interesting trend, Philippe alluded to this, is the developments in the debt markets over the recent years, and particularly the education of debt markets around investing in technology. Some of these business models, particularly software, do lend themselves very well to supporting leverage, and increasingly investors are understanding that. That means that brings in new segments within technology into play for candidates for leverage buyouts. Both Europe and Asia, as I mentioned earlier, are becoming more important parts of the technology economy, and that brings in new geos for this style of investing. And then finally, fund sizes are increasing, firms are getting better at syndicating investments, and that means that bigger deals come into play. All of these things make the sector particularly of interest to technology. So basically, to sum up, we see technology as an important playing field for private equity. It's a very large market. It has some very attractive characteristics, but it's not a place you can dabble in. You have to be a specialist to be a successful investor within this arena.
Good morning. The EBRD is a bit of misfit, if anybody know about the organizations, to this LBO discussions. But given the theme of this sessions, which is sort of predicting next 10 years in some kind of crystal ball gazing, we thought we could provide you some insight about what's happening actually in your home turf, which is in Europe. And EBRD, I think many of you know that we've been conceived by the long time ago by a French socialist government to help the transition of the former communist bloc economies into market-based economies. And we've been investing in the region since 1992. We basically run the region's largest fund-of-fund program. All our portfolio are based in Central and Eastern Europe, including Russia's. And so here's a bit of a synopsis of our portfolio, which is we have been investing in cumulatively 92 funds, nearly 60 relationships. That's lots of funds. And the underlying portfolio company is now reaching over 850. What I'm trying to show you is that we've been accumulated quite a few information through these portfolio companies, and looking through these results from our exercise and to see what's happening and what could happen in the Central and Eastern Europe as a part of the greater Europe, and in the context of the private equity investments, how region could play out in the game that we are playing today. Just the way we do it is that we look through the funds and collect the information of the underlying portfolio companies. So we could see where the fund's investing, what kind of industries funds investing, but also what kind of styles the GPs are applying when they're investing in emerging Europe. Okay. Just to get the sense of the size, I've been hearing many hundreds of billions of euros and dollars in this morning, but compared to those markets, actually the emerging European market is quite small. We made some estimations based on what we've been investing. So if you see on the left side column that we've been committed something slightly below 2.5 billion in terms of dollars in the past 12 years. And then we multiplied that by the numbers basically to get the aggregate capital committed to the funds that EBRD has invested. And then we added some numbers to just make some guesstimate the overall size of the market. And we believe that markets is somewhere between the 20 to 25 billion US dollars. That's more like financial private equity investments, excluding the strategic investment done by the large corporates into the regions. And just in a very quick snapshot, and probably this is not a good outlay of the situations, but we compare what kind of investment style stage in these private equity funds doing, and then we try to compare that one with the EVCA result. So when you look at the what it says in yellow bar called CSE, that means Central and Southeastern Europe, And the pink one is the CIS, which is the former Soviet Union countries. If you look at the Central and Eastern Europe, or Central and Southeastern Europe, most of the transactions now become buyouts, and that's comparable to EVCA figures. The regions are always not great at investing in ventures, early stage investments. That's quite a few proportion of investments. And if you actually look at the last years, the country still are very much expansion capital investments. So I don't think the country really gets to the mainstream buyouts market yet. But we could really say that especially the acceded countries, the new EU 10, and from our perspective, actually EU 8 countries, that includes Hungary and Poland, Czech Republic, and so forth, they're really getting into buyouts markets now. And that's also endorsed by the fact that many of the banking institutions in these countries are now owned by foreign strategic banking players, and they are willing to play a very similar game that they've been playing Western Europe today. Again, this is not entirely clear what's happening, but we're trying to plot in this chart that what sort of investments that the underlying portfolio company are being done, and it was by the volume, so it just look at the aggregate transaction volume in each way of investing it, and that's also based on the sort of EVCA categorization. Now, in the past, what we call the fast way of the Central European private equity market, most of the capital was provided as expansion capital. But now, as you can see it, this pink bits of the charts going up, and that's the buyouts, the statistics. So we see that in the past 2 or 3 years that the buyouts category of the investments are expanding in the Central and Eastern Europe, and that includes the former CIS country, the current CIS country too. So the large part of the expansion capital is actually represented by the funds invested by Russia and CIS-focused funds. Next slide, please. Oh, yes. Oops, no, let's see, one slide back. Yes. And this is the sort of exit categorizations. And as you can see, there's a big bump on the trade sale on 2005, but I think that's represented by the very heavy exit activities based on the buoyant market and high liquidity in the market. But historically, this market is not an IPO exit market. Its main exit route is always trade sale, although the IPO possibility is increasing, but it just doesn't show up in this chart very well. But I think you could consider that the main activity of the exit is a trade sale still in the Central and Eastern Europe. This is what we call the gross result chart. What we consider the return from the underlying investments over time, and what we normally categorize it is that all funds and all survivors, and all survivor means that there's the market is still premature, and so that we don't do a quota on the growth basis. We look at the investments which has been done, the GPs who managed to raise the follow-on funds, and that therefore the survivors reference comes through, and look at the portfolio companies managed by these survivor GPs and what has been the returns to date. And as you see it, as the current running basis, it's already exceeding 20%, and we're quite satisfied with the result. And this is the net returns to LP, including EBRD. And this is again the survivor returns on the past 10 years plus since inception. And as you have seen it, the Central European markets has been really catching up with the Western buyout market, and we would imagine that by the time we hit the next year in 2008, the 10 years returns would probably reach somewhere near the at least the top half of the Western European buyout returns, and also probably the Russia CIS, if everything goes as it is going today, it will probably provide the demonstrable risk premium over what the Western private equity funds returns are providing on a top quartile basis. So again, the regions, despite its reputations and despite the reasonable understatements compared to the Asia market, has a very clear return track record today, and will believe that this continue to be a very attractive market as a part of the Western European emerging market. And again, the question of the capital overhang, if you look at the typical statistics that how much of the money going to the private equity in the GDP basis, that the aggregate of the EU 15, that's the country which represents the old EU members, to the Eastern European countries, the number of or the percentage of the Eastern European countries in private equity vis-à-vis their economies is a totally small market, and we believe that there's still room to grow, room to expand. And European statistics is sometimes a bit skewed. I think the reason why Denmark is so high end of it because of the Tele-Denmark transaction last year. But usually the Scandinavians in the UK, the percentage compared to the rest of the EU countries. But even so, that the countries which we have been investing represent very small proportions in terms of their GDPs, and the growth opportunities will continue to exist in these markets. So, thank you very much.
Thank you.
Good morning, ladies and gentlemen. First of all, as Philippe pointed out, it seems to be the trend is either you are one of the big buyouts or you kind of are a niche play in a certain region. Well, Evolvence Capital, for the time being at least, definitely belongs to the second kind. Let me just give you a brief overview of who we are. We actually were founded in the year 2000 by a gentleman called Khaled Al-Muheri, who used to work before for ADIA, the Abu Dhabi Investment Authority. We are focusing on alternative asset classes. We have a headquarter in Dubai as well as offices in India, New York, and London. We are owned, it's quite interesting, we actually owned ourselves by 13 high net worth families from the region, from Saudi, from Kuwait, from Abu Dhabi and Dubai. And at the same time, though, also offer our own product. So we are GP and LP at the same time. In terms of the latest products that we have is we focused quite a bit on India, and there we came out with the first independent India fund of fund, which is actually a country-specific fund of fund, and as well an direct fund, which is a life science fund. And more information if you want to ask me about it, welcome afterwards. So let me just give you a brief overview of India and why we decided to go into India. For the next slide, please. Thank you. First of all, if you look at the GDP growth of India, I think it has been quite a success story, particularly the last 10 years. And while it is worthwhile to point out that we had a growth rate between 6 and 8% on a GDP level, also the quality of growth changed quite a bit, because 10 years ago you used to have the majority of this growth coming out of agricultural activity, while nowadays about 55% is linked to the service industry. And also when we talk about India's foreign exchange, we are now about 165 billion US dollars that India has in terms of reserves. So again, in terms of currency risks, which used to be the case 10 years ago, I think we can look into this subject with much more comfort. Next slide, please. Next step to think about is how India develops, or what are the factors actually that are the reason for the growth of India. And here again, it's important to see that it's not only kind of export-driven kind of factors, but also the internal demand is growing rapidly. And this again has to do with an increasingly growing Indian, let's say, middle class. As you can see here, we're talking about the year of 2015. We're talking, you see a strong increase in the upper middle as well as in the emerging class. And I think this is, and while we see a decrease when it comes to kind of the poorer level of society, which is, by the way, in strong contrast to, for example, what's happening right now in China. I think 2 days ago there was an article in the FT that kind of compared, again, this is an old subject, an old topic, China versus India. And while I believe in both countries you see huge opportunities for private equity, I think some factors are more beneficial, for India, and this is one of them. Next slide, please. Now, talking about private equity, if you compare or if you look at this chart, you see a rapid growth in terms of private equity activities. We are talking about, in the year 2006, of, I think by September, we had about $5.4 billion they were trying to find their deals in India. And overall, by the end of 2006, we are thinking of kind of crossing the 7 billion line. And this, of course, next slide, please. This led to quite a number of players right now in the private equity industry. And I would like to spend just a bit of time actually on this chart. First of all, if you look at the axis, you see on the x-axis, on the left side, the early stage kind of VC players. Then you see the area of growth capital. And on the right-hand side, the kind of big buyer players. And then on the y-axis, we have on the lower part the independent local players. In the middle field, the affiliated, or the players that are affiliated to other financial institutions. And then on the kind of upper area, international players with presence in India. Now, we, as Evolvence Capital, do strongly believe that nowadays the, let's say, interesting area for private equity is in the middle field, in a kind of growth, let's say, growth capital area. And the reason being is quite simple. When you think of India, again, with the kind of growing kind of exports as well as growing internal demand, the companies there are not, for the time being at least, not that interesting for buyouts, right? They want to grow. Having said that, probably in 3-4 years down the road, you see kind of more and more deal flow also coming up on the buyout side. For the venture side, yes, there are some coming up. But again, it will take some time. So we definitely see the interesting area in the kind of middle field right now. Next slide. And then just also coming back to the topic of India versus China, and people asking is India going to be the next kind of China? Well, these are charts that have been provided by a UBS report, and I think it was quite interesting to see because they answered the question, well, why should not India become the next China? So what you see is on the left-hand side a kind of increase of gross domestic savings, where you can see that India right now is just basically almost on par with the kind of average Asian countries, and as well as China. And in terms of export growth, if you take this is kind of on the right-hand side, you see the same chart, starting for China in the year 1970, for India in the 1980, and you see again a very similar kind of growth pattern. Then on the other side, we believe that things like, for example, the one-child policy in China probably might actually backfire in terms of, internal demand and everything else. Why I think India's population growth right now is more to be seen as an advantage than a disadvantage. Thanks for your attention.
Okay, so I represent the debt side of the private equity world. A very brief overview of who we are. We are the largest institutional investor in leveraged loans in Europe. We manage 6.5 billion in Europe and about 12 billion in the world. We are mostly invested through senior loans, mezzanine assets, high yield bonds, and other debt instruments. We are the people ultimately holding the debt that private equity requires to fund its transactions. So in terms of the recent developments on the debt side, historically LBOs were funded through a small number of instruments, including senior loans and mezzanine debt and high yield bonds. Over the last few years, there has been an increasing sophistication of the kind of instruments available to private equity. I listed a number of those new instruments, at least for the European market. Second lien is one of them. Second lien is an intermediary instrument between a senior loan and a mezzanine instrument. Floating rate notes, which are a new instrument available to private equity in Europe. It's much more flexible than high yield bonds for private equity sponsors in terms of the call protection features. Holdco PEX, it's been existing in the US for a long time. It's coming to Europe. Depending on the structure of the Holdco PEX, it's sometimes very senior equity or very junior debt. It's still a new instrument for Europe and takes different forms really. Securitization is a new form of financing for private equity in Europe as well. The good news for private equity is that it's cheap debt, it's long-term debt. The bad news for the other lenders is that it probably eats some of the security to the senior debt and to the other layers of debt. But clearly for private equity, there has been a great instrument recently in Europe. Real estate financing as well, we see a number of transactions, including now OpCo and PropCo type transactions. Same thing, the idea is to provide cheaper financing for private equity houses. The only problem is that once again it eats some of the security for the other lenders. So it's good news for private equity, bad news for the rest of the capital structure. If you can come back just slide before, yeah. On the real estate side as well, we see a number of transactions as well incorporating sale and leaseback transactions. But again, the idea is that the market is increasingly sophisticated. There are more instruments available. Those are cheaper instruments for private equity. Next slide, please. The instruments have changed. The players have changed as well. Historically, the debt was provided by the banks and by the banks only. The banks were providing in Europe, for instance, in 99% of the debt. The market has changed. One of the reasons has been the regulatory change in the market, Basel II, etc., that have made that kind of assets very, very expensive for banks to hold. As a result, banks had to offload these assets. A new class of investors have appeared in Europe and the US. In the US, it was 10 years ago. In France, it was 5 years ago. Sorry, in Europe, it was about 5 years ago. The US market is now 75%. The US leveraged loan market is now 75% non-bank. In Europe, it's 50% today. Again, 5 years ago, it was about between 1% and 5%. So that's the new trend, and it will continue growing. So the banks don't hold the debt anymore. Those are institutions like ours that ultimately hold the bank, the debt that helps finance the private equity transactions. So who are the new players? CLO managers. We are CLO managers ourselves. They are about 70% of the institutional market in Europe. We've got hedge funds coming into the market, whether they are straight hedge funds, whether they are credit funds. There's a very kind of blurred limit between a credit fund, a hedge fund, and sometimes a CLO manager. But the new trend has been a number of US players coming into Europe and investing in that kind of debt. One of the reasons for that, one of the attractions for them, is the fact that the equity markets, the public equity markets, have not been yielding enough returns, and the European leveraged loan markets have been yielding much more decent returns, and there's been a shift between equity allocations and debt allocations, and private equity funds themselves. So that's an interesting new trend. In the US, it's been the case for about 3-4 years. In Europe, only over the last 2 years. In Europe, you have funds like Carlyle, like Blackstone, CDC recently, Permira setting up a fund now. So private equity funds are themselves launching CDO funds, and they become kind of multi-asset managers. That's the new trend in Europe today. So as a conclusion, in terms of the change in the players, the interesting thing is the shift between banks and institutional investors. Now, in terms of the impact of both the change in the instruments available to private equity and the players.
Sorry, Pascal. I'm really sorry. I think that's all the time we have today for this discussion. Do you mind wrapping up very quickly?
Okay, I'll try to do it very quickly. But
I'm sorry.
You have, the conclusion is you have positive to private equity. You have more debt, you have cheaper debt, you have access to financial engineering. That's a new way to create returns from private equity, and you have more control of your transactions because the banks and the institution have less control. The negatives are the risk. There's additional risk to this transaction. the fact that private equity returns are not derived only from operational improvements anymore, but through financial engineering. That's risky going forward. The increased supply of debt increases artificially the kind of acquisition prices paid by private equity sponsors. So liquidity in leverage in the leveraged debt adds risk. If you can just move very quickly to the next slide, because in terms of the future, that's the cycle today. Between 97 and 06, you can see how the average, if you want, acquisition price in terms of multiple has gone from 7.3 times in 97, 8.2 in 98. Then you had the downturn. Then you had the credit crunch. Now we are in 06. We are much above the kind of levels achieved in 98. That means there will be a credit crunch. Next slide, please. When will it come? We don't know yet. We think it's going to be 2008. We're invested. The reason we think that is because we're invested in 150 LBOs in Europe, so we have some long-term trends in that respect. We feel there is too much liquidity in the market in 07 to see a credit crunch. We think it's going to happen in 08. Now, the impact of this credit crunch to private equity firms will be less access to leverage, will be a slight power shift from equity investors to lenders, which has been a contrary over the last few years, and lower returns to private equity, which will potentially have less access to financial engineering, will have to put more equity into the deals. Now, the good news for private equity is the fact that the cycle will last for a shorter time. Because of this kind of supply of liquidity on the debt side, CLO CDO funds have tied money for 13 to 15 years. Even the hedge funds have increasingly locked money. So the good news, again, is that the cycle, where it lasted about 3 years the last time round, the kind of credit crunch, the credit shortage will probably last only 2 to 3 years. That's the good news to private equity. And that's
Thank you very much, Pascal.